Hey everyone, my name's Andy. My channel is Finding Value. If you like this content, click that thumb up button. Subscribe if you haven't. And if you're new to the channel, welcome to the channel. So someone asked in the comments section, what about the exit strategy? What's going on? Right? I'm telling you how to buy all this stuff. I'm showing you how to value things. I haven't talked much about an exit strategy. It's fair. So I'm going to go over an exit strategy kind of to show you what to expect over these years. Now we're at the beginning of this bull market. We're not anywhere near an exit right now, but it's always best to know what the exit strategy is. So let me go over this. I'll tell you what to look for and some traits for an exit strategy here. So exit strategy, what does an exit strategy look like? What about previous bull markets? How do we know when to sell? I loaded up on all these insanely awesome companies. I held on, but what about selling? What about this exit? So this is how we're going to play it. Real estate will enter the end of its expansion phase and enter into an oversupply state. We will see this in the metrics of real estate. You're saying, well, I thought we were in a commodities boom. Hey, this all ties together. You're going to look at inventory, days on the market, foreclosures, high interest rates, and high prices. The inventory is going to be increasing, the days on the market is going to be increasing quite a bit, and your foreclosures are going to start going higher. During this time, you're going to be at higher interest rates, and the prices of real estate are going to be very high. We are not at high prices yet. You haven't seen anything yet. You'll see what high prices are 5 to 6, 7 years out from here. We're going to see commodities expensive to the S&P 500 in that ratio. That's going to be one indicator to sell. We're going to see that the commodities themselves are going to be expensive to gold. That's other indicators as well. And the gold to silver, just for your FYI, is going to go up about 3 years past the peak in the commodity to S&P 500 ratio. It's got 3 more years past that ratio peaking, roughly. We can also see it in housing starts. Housing starts are going to decline. And I'm going to show you on previous bull markets what all this looks like on charts. So first, I'm going to go over the market cycle for real estate. Real estate right now, this is the housing starts. This is about 1.5 million housing starts is this line right here. This is the long-term occupancy average. When we build homes and start homes above 1.5 million, we go into what's called an expansion phase of the real estate cycle. This phase right here for housing starts is going to go over 1.5 million and will be expanding with new construction. At some point, we're gonna overproduce and we're gonna hit a hyper supply. That is when the top's gonna happen in our commodities boom. And I'm gonna show you on housing start chart. I'm gonna show you all these things. So this is the commodity to S&P 500 ratio. These are bottoms here. And then the tops are in the red circles. What I'm gonna do is I'm going to show you the green and red bubbles here overlaid on the housing starts. So housing starts is this. This is from a Fred housing starts, total new privately owned housing unit starts. I overlaid these bubbles on this chart. This is the 1.5 million roughly mark right here. This is green, red, green, and then we're going to have a red somewhere up here. Now, notice that the housing starts have always been over this average, which means we're in a real estate expansion phase. We're in this phase here, and we're just looking at the housing starts, and it's always peaked when the housing starts peaked. Green is the bottom of the commodity cycle, top of the commodity cycle. Right now, we're going above into an expansion phase right now, where we're going to go all the way and hit a top of the housing starts. This is just an overlay. So we want to see a peak here and then a decline, and then you know that you're at the top. So this is going to be at a very high area for housing starts. That's going to be a sign to exit. Also, I've got a uranium to gold ratio here. This is the ratio right now, which means it's like never been this cheap for I don't know, maybe even ever. What's going to happen is you're going to see a contraction of this ratio downward over time. And eventually it's going to get to an expensive state. I put the green arrow or the green commodity bottoms here, and I put the tops in the red. That's still overlaid on this chart. This is where the overlays are. So this is expensive for uranium. This is cheap for uranium. And we are at ungodly cheap for uranium right now, which makes me think we're going to go all the way down to this expensive spot way down here. We may even go lower than these guys when it flashes a red. So we're going to see this contract and go down to the bottom portion of these charts. This is gold to oil ratio. We're also going to see, we're up at around 40 right now. It's declined a little bit. So we're right up here, which has been cheaper than history. This ratio is going to decline over time, all the way down to probably something under 10. So we're going to see this contract. And when we see all these different commodities, they're going to all contract down like this and outperform gold. And that's where our purchasing power gains are going to be had. So we're going to see all these ratios contract down, and eventually they'll get expensive in relationship to gold, and that will be our signal to sell. Also, we're going to probably see something that looks similar to this type of bubble right here. They call it a bubble. You'll have a stealth phase. We're buying like somewhere in this stealth phase. And we're going to have an awareness phase where institutional investors are going to start piling in, and then we're going to have this public jump in at the end. This is where Tesla and Apple and all those companies look like this right now. They're all somewhere over here. So this was the previous bull market for VALE. It went from like a couple bucks all the way to 40 something dollars here. And you can see it, if you look back, it's kind of this move, and then it goes up at a higher move, and then it goes up at a vertical move. It's three kind of things. So it's a nice, easy move, and then it went into an intermediate institutional buying phase, and then a retail phase at the end. So if we were to overlay those green, the green circle would be here, and then the red circle would be at the top here in 2008. That's what these circles would have indicated on this chart, 98 to 2008. So it was flashing red at this peak right here. We see it in the chart that we're in a new paradigm kind of public topping phase, and we would be selling out probably through this cycle all in here. That's where we'd be selling. So the conclusion here is at the end of this cycle, we will cost average out when the ratio tells us it's time. And the ratio is the commodity to S&P 500 ratio, and all of the ratios in relationship to gold. Whatever that commodity is in relationship to gold, they're all going to be flashing sells. They're all going to be flashing overpriced, overvalued. Use technical analysis to time our exits as best we can. We're going to rotate our investments into other undervalued investments after we rotate out, and it's probably going to be something on the lines of S&P 500. So when we go from a high interest rate and that interest rate goes lower and lower and lower, that is exceptionally good for bonds and the S&P 500. And actually, bonds might be one of the best investments at that time because it's going to be exceptionally high. The interest rates are going to be super high, and they're going to be paying out. My guess is they're not going to go that high because it's probably going to bankrupt. The government, because they're going to be printing so much money. It's probably going to hyperinflation or something like that, because they're not going to be able to afford it. You can't afford 10% interest rates right now with how much debt they have. Also, I had on there, made so much money that we party. It's going to be a lot of money made. 40x, 30x, 60x on a lot of these companies. 40 times your money, 60 times your money. You put $1,000 in, turns into $60,000 or $40,000 each thousand that you put in. That's what's possible. That's why I want you guys to hold on through this entire thing. And then when the ratios get expensive and everything starts looking like it's going to turn around, we cost average out. We don't just sell everything, we slowly move. Nice, just like we're buying, we're cost averaging in, spreading that risk out, we're going to cost average out. Same thing. So hopefully this gives you a little bit better picture of an exit strategy, of what an exit looks like. We're going to be selling this when it's all overpriced. Not when it's cheap, but when it's overpriced. When the charts look like they've gotten a bubble territory, when the housing starts to decline, when real estate, all those metrics start turning bad for a year or two, because it takes about a year or two for the prices to start to decline in terms of real estate. That's when we know we're at the top. So if you like this content, click the thumbs up. Please subscribe if you're new, and thank you for watching. This is Finding Value.